All right. Want to be sensitive to everybody's time. I know the invite shows an hour, but we'll try and keep it to 45 minutes. Thank you, all of us, for just being on here. I'm humbled, excited, um, and just thrilled that you are here joining us today for the first plan audit webinar. Or if you're a plan sponsor, I think it's just an amazing thing that you're here with us today. I think that there's um, just the fact that you're looking to add on to your knowledge when it comes to the survival guide for preparing your first plan audit, preparing for it. Whether you're talking to your clients as a service provider, I think it's a great thing just to be able to add more tools to your tool shed and to talk to your clients more and more about this and feel like you're adding more value to your clients. And if you're a plan sponsor, this is really what we're here for. We're trying to prepare you, guide you, provide you with additional information so that you don't have the anxiety or worries going into your first plan audit. We want you to be confident, comfortable going into it, and know that there's things that can go awry, they can go wrong, errors that can happen. But the good thing is that these are all things that can be very easily fixed. So we'll dive in and we'll go through it. Quick administrative things. I'm your host, Alex Sanchez, along with Jason Figgat, who's a partner of mine. And we're both really, here. We've been in the game for 20 years approximately each. We decided years ago to focus and dedicate ourselves to this practice of EVP auditing. I myself did corporate audits, nonprofit engagements, and then 6 years ago decided to join pension assurance when I found out there was a pension assurance that existed that was dedicated to this space that was frankly underserved when it came to the EVP side of things. And so, we celebrated 10 years last year in November, and we started with 125 plans. And we'll go over some of the stats. But, excited to be here, excited to see where we're at now compared to 10 years ago. We're 100% specialized, as I mentioned. This means we only hire audit professionals who are ready to commit to 100% retirement plan focus, right? So we've got 70 people virtually connected throughout the country, and we don't offshore any of our work, so all our people are local, and we're all dedicated to this space. So they all share similar stories to Jason and I, in that we all at one point said, we're going to focus on this area, and we want to do this. And I think part of the attraction to it is not just the ability to specialize in it, but also the fact that we get to have work-life balance, in that we have a true off season from November to February to decompress, re-energize, focus on how to make things better in terms of process, client experience, and so forth. And it gives us the ability and time to be able to just make and run our practice even better, right? Deep experience and expertise. In 2024, we audited 950 retirement plans, constituting approximately 25 billion in plan assets across 543,000 participant accounts. This year, we have a goal of crossing the 1,000 plan mark, making us one of the top firms in the country in this particular space. Always like to share our vision and mission. Why are we here? Why do we wake up in the morning as a firm? What are we aiming for? And this is our vision: to become a national leader in the area of retirement plan audits in quantity, quality, and subject matter expertise. And then our mission really is part of what we're here, why we're here today: to deliver value and education to our clients through our retirement plan audit process by cultivating a team of experts that provides the highest level of service and efficiency. So that's really why we're here. We just want to pass on information and be a resource for you all. So I'm going to hand it off to Jason. He's going to go ahead and cover some of the objectives, get into the meat and potatoes, and talk about audit efficiencies as well. But I also wanted to let you know, if you have to step aside for a call, a meeting, whatnot, don't worry. We are recording this webinar, and we'll provide you with the link afterwards if you registered for this event. So don't worry about having to take copious notes throughout the presentation. We will provide you that information so you can watch it on demand, and can send you the slides as well. So do not worry about that. And then we want this to be informative as possible and helpful. So ask questions throughout. We will work on answering those throughout the presentation, and then as well as leave time on the back end to answer those questions for you. So And if we don't get to it, we'll reach out individually and address those as well.
Thank you, Alex. Again, everyone, thank you for joining us today. We're happy to be here and we're happy to share this information with you. So a quick overview of what we'll be discussing today. First, I will be discussing when a plan audit is needed, selecting a plan auditor, and the DOL audit study. Alex will then take over and discuss documentation needed during the audit, how you can help, how your plan service providers can help you and support you in your audit. I will then discuss some common audit findings and some tips on how to get ahead of those. And then Alex will close us out by discussing or having some discussion regarding the general audit timeline that we provide, but also what you should generally expect from your auditors, regardless of who you're using. Go ahead. Next slide, please. Thank you. So discussing who needs an audit. First, it's really best to think of the audit requirement not as something that you fall into, but that is always there and you get exemption from. I think it's probably the better way to think about it. And to start our discussion today, we're going to start by focusing on ongoing audits or ongoing plans. I'll discuss inception years just very briefly so you have that in your knowledge base. But if you are a ongoing plan, then the principal delineator of whether or not you need an audit is based upon the number of participants as of the beginning of your respective plan year. And the definition of a participant has actually been simplified relatively recently. So effective January 1st, 2023, a participant is anybody with a balance in the plan. We used to think about people who were eligible but not there, but that is no longer the case. We are only strictly focused on how many people have balances in the plan. That is your magic thing that you need to be keeping in mind as of the beginning of your plan year. If you're an ongoing plan, then you must exceed 120 participants. So again, individuals with balances, you must exceed that number. So 120, you're coming in just under the wire. If you're at 120, I would strongly suggest you double and triple check that number just to make sure that you're not actually facing an audit and someone had miscounted someone somewhere along the way. So that is the threshold that once you cross over 120, if you were not audited in the prior year, you are now subject to audit. Once you have pierced that threshold, as long as you remain above 100 participants as of the first of your plan year, then you will continue to require an audit. If you drop below 100 participants as of the first of your plan year, you are no longer required to have an audit. Technically, you may have an audit if you want, if you're below 100. Why you would ever do that, I can't speak for those people. It's not necessary. If you really wanted us to, we could. I think in the duration of my career, I've been asked to do it like once or twice, so it's certainly not a common thing to do. Anyway, that's generally speaking what the audit requirement is. Now, if your plan is newly incepted, so it's been freshly created, your audit criteria is a little different. First of all, it's based upon the number of individuals with balances as of the last day of your standard plan year, and it only has to exceed 100. I won't get into the minutiae of why that is, but just know if you are a newly incepted plan, the rules do change slightly. So please be aware of that when you're evaluating, do we even need an audit in the first place? Next slide, please. So, okay, you need an audit. Selecting an auditor. This is where it gets, I think that the question becomes far more interesting. And by no means are we here to dunk on other auditors or other CPAs that you may have relationships with. However, we do want to make sure that you are equipped to ask the right questions about those other auditors or CPAs you may be entertaining as the examiners of your plan. First thing to keep in mind is your corporate auditor may be your first go-to solution in your mind, but it may not be the best solution for your plan. The reasons for this can be varied. One of the challenges I know that I always faced, and I know Alex faced at his full service firm, full service firm where he worked, and I certainly had a similar experience, and this is, I think, almost universal, is that it's very difficult to get the resources necessary to be able to properly support an audit. It doesn't mean it can't happen, but those instances where you have a solid team and they can take care of themselves, that is not guaranteed. And experiences may vary there. So just something to keep in mind. If you have a full service firm that you're happy with for your other work and you want them to do your employee benefit plan audit, ask them, how do they support their employee benefit plan work? How, is it a priority for them? If so, what do they do to support it as a priority? Totally legit questions and things that you should be thinking about. Also, as Alex had mentioned previously, we do not outsource any work overseas. We are seeing this as a more present trend amongst many of the other firms that we see doing benefit plan audits. So if you care about that, you should ask that question. Just because data is going overseas doesn't mean it's going to be lost or stolen. I want to be clear. But if you feel that that is a criteria that you want to weigh when you're assessing your options, you should know that's a question you should be asking. Just to kind of run some of these other ones, but a little bit more quickly here. First of all, it's like the space has become more technical. It's been subject to additional scrutiny. Why you may be thinking as a plan sponsor, why do I care about the scrutiny my auditors are being placed under for their benefit plan work? And the answer is simply that if a plan's audits are examined by the DOL and they are found to be deficient, the audit can be rejected. And that means that congratulations, you as a plan sponsor, if you thought paying for one audit was annoying, how about paying for two? You'd have to pay to have the plan re-audited. This is the more extreme example, but it does happen. And again, it's why we feel it is absolutely worth your time to be aware of the types of questions you should be asking and how you should be considering and thinking about the auditors that you are engaging with, either directly for your audit of your plan, or if you're an advisor, the auditor for the plans over which you are, or over which you're responsible. I think that's probably it for this slide, Alex. We can go ahead and go to the next one. So I mentioned the DOL and their inspections. So about every decade or so, not exactly, but approximately, the DOL does what they call the audit quality study. And what they do is they look at all the firms that do employee benefit plan work and basically assess what does the failure rate amongst these audits look like. And even though it is technically an improvement for 14, so it's a little maybe visually misleading to have the scale go up and up and up, you can see that we've been consistently north or at 30% overall failure rate when the DOL examines the work papers of auditors who do employee benefit plan work since 2004. That's kind of scary. Almost a third of the audits being examined have major problems with them. And however, when you start to break down what makes up these numbers, I think it gets even more interesting. Next slide, Alex. So this is, I think, really where the DOL audit quality study really starts to yield some useful information. As you can see, if an entity audits more than 100 plans annually, their deficiency rate is all the way down to 17%, much better than that overall rate of 30%. But as you look through the scale of as fewer and fewer plans are audited by an entity, the rate at which failures occur increases. Now, let me just be very clear. There are some fantastic practitioners out there who have small, dedicated books who absolutely know what they're doing. And just because you choose one of them for your audit work does not mean you're going to have a failure. So please know that I'm not besmirching my brothers and sisters who do that sort of thing. However, it is worth knowing that it is a greater risk. So if you are not very comfortable with the works those types of entities are performing, you should have some additional scrutiny there. You should be asking some additional questions. Again, I would harken back to some of the data points that we had mentioned previously, asking them, what do they do to support it? What is their internal quality, like quality control look like? Those are questions you are absolutely entitled to as a client or somebody who is attempting to bring services on board for your clients. You're absolutely entitled to answer that question. And I would not feel comfortable being part of a firm that couldn't answer that in a reaffirming and confirming manner. But yeah, as you can see, those that truly only dabble in this space, the failure rates get to be pretty horrific. And again, that's where we see a lot of the problems in this space are, where people just think, oh, I can do that. And frankly, there's quite a number of people, as this study indicates, who do employee benefit plan audit work and frankly have no business of doing it. Next slide, please, Alex. So again, just kind of as a recap over the quality study and how that impacts your assessment of the auditor, is that, the audits are evaluated by the DOL and peer reviewers, our internal peer reviewers. We didn't really talk much about them, but they're still important. Those are other CPAs that come and look at other CPAs' work. So we have a peer reviewer. I think every firm has a peer reviewer or is required to undergo peer review. The DOL inspections are not, every firm is being subjected to them. But once you get over a certain threshold, they come and visit you on a regular basis. We're now over that threshold, so we've already been visited by them relatively recently, and we expect more visits in the future just because we do enough of this work that we're now on their radar. Again, keeping in mind that overall, 30% of these audits, they have failed in the DOL's eyes, and that's, again, not good. And if there is a failure, there is a potential rejection of the 5500 filing, which again means congratulations, you now get to pay for a second audit. And that, it's really, really critical, and I could have told you this, but the DOL study also backs this up, that, having a sufficient depth of expertise is absolutely critical to being able to help ensure that your audits are going to be performed successfully and that you're actually going to get value out of this cost that you're expected to incur. And with that, I'm going to pass it back to Alex.
Yeah, thanks, Jason. I actually just had a couple of months ago, a client of mine or a prospect actually received a letter from the DOL with a rejection notice for their 22 audit, and they had to redo it. So they reached out to us to see if we can do the 22 and 23 going forward. And it's a nightmare, having to go through that process again. After you paid for it, spent 40 plus hours assisting auditors to get it done, to get a rejection notice and not know why, it's alarming. It could be alarming for a plan sponsor. So you want to do your due diligence when finding who you're going to work with from a CPA standpoint. It's not something you search for every day. It's not like you're looking for a plumber or electrician or a doctor or dentist that you assess every so often. But so want to walk you through the RFP process here with this slide, and what are the questions that you should be asking for when determining who your CPA should be to hire on to handle your 401k audit. So number and types of plans audited by the CPA is an important figure, right? We talked about, us approaching the 1,000 plan mark. The question, is not only the firm, but also if you're hiring a local firm location out, in your area, find out how many plans are run by that location. And who's going to be on your plan audit, and how much experience do they have, right? It's not just about the firm overall. For us, we're centralized. We have 70 plus professionals that are virtually connected, and all the decision making is done under one umbrella, one house, basically. So, but not every firm works that way. You might have a national firm that has a local office that made up of a few partners and maybe 30 or so people. And maybe their decision making is just done in silos, and it's done in that location, and they maybe only have 5 or fewer plans that they audit in a year. So you want to find out, at that granular level, what the situation is, what you're getting into there. And these are in no particular order, but amount of plan specific training possessed by the CPA. We're required as CPAs to get 80 hours every 2 years of CPE. And so with that said, what is that CPE focused on? Most firms will focus on those higher margin, higher risk engagements and focus their education in that realm. Whereas with us, because we're dedicated to the space, it's all EBP related for the most part. So firms' commitment to the plan audits, what percentage of revenue? For us, it's 100%. you want to find out what percentage of that revenue, again, what area are they focused in? What are they dedicated to? If it's 2%, are they really going to focus on the EVP side of the practice in their day-to-day? Specific team experience, as I mentioned, who will work on your audit? Is it going to be an intern, first-year staff coming out of school, or are you going to get, really somebody who knows what they're doing, working alongside you, and getting a better client experience at the end of the day, which is what matters. And also just to look after you and to make sure that they're doing a good job in terms of the audit, so you don't have that situation where you're having to go through a re-audit, or somebody that may not find the things that they should be looking for and finding through your audit, to make sure that things are cleaned up if there is an error that needs to be fixed. Having a more experienced person that has seen things and been there, done that is extremely helpful. Is the firm a member of the AICPA EBP Audit Quality Center? That's just another tool, another thing to ask to see if they are dedicated to the space. If you have that, then there is a level of comfortability that that firm is dedicated to this arena. So good question to ask there. The status of the CPA's license with the State Board of Accountancy. Not every state works the same way. We have Nexus to be able to service accounts just about in any state, but there's some states that require additional licensing and paperwork requirements to file and to be able to service accounts in a specific state. So you can look them up through the State Board of Accountancy, whatever state you're headquartered in, and see if they can service your 401k that way. Has the CPA been subject to any prior DOL findings? As Jason alluded to, we go through a DOL inspection ourselves, and a peer review as well every few years. So, finding out, are there any DOL findings with that inspection that was done? Have they been peer reviewed for their 401k work? Most firms go through a peer review process, but the peer reviewer will analyze and sample a set of files based on their setup, their model. If most of the work is done on corporate audits, then they're probably going to review more corporate audits than 401k work. And if their 401k work is maybe just a handful, they might pass completely on reviewing the 401k work. So is that peer review that was done that shows a clean opinion, was that based on their 401k methodology, testing, their performance in that arena, or not, right? So those are questions that you often have no clue to ask, but hopefully this helps you kind of get the right questions in your due diligence process as a committee and a plan sponsor. And then the audit fee, it's a qualified plan expense at the end of the day. So you don't want your participants to be overpaying for the audit fee, so it should be reasonable. When you're looking at that, making sure you're benchmarking the fee as well is important. On this slide, I want to talk about, you might hear it here and there, 103A3C. What does that mean? It's a tongue twister. What does that mean to the plan sponsor, right? And so these used to be called limited scope audits, right? So the 103A3C, formerly limited scope audit, it's a standard section, or it's a section that talks about and gives us the ability to ignore testing the investments, so we as auditors can focus on testing participant accounts. And it's basically, to put it in layman's terms, you've got these companies like Fidelity, Empower, Principal, Transamerica that get audited at a higher level by typically a national firm, and they'll go in and audit the internal controls, they'll audit the investments. And so once they're done at that level, there's no point in us, thousands of auditors that are out there, to audit these hundreds and hundreds of plans that have the same investments across the board for their performance, when that's already been done at a higher level. So it affords us the ability to, as auditors of employee benefit plans, to focus on participant transactions, right? So there's still a lot that we look at, contributions, distributions, vesting, participant data, and anything else that doesn't directly pertain to investment valuations is still in scope, right? So there's a lot that we do, and we'll go through the PBC in the next few slides to talk about the things that we ask for, and you'll see that there's a lot that goes into these audits. Leveraging service providers. So one of the things that we focus on is trying to make it as pain-free as possible. There's a bunch of different service technicians and service providers that touch the 401k plan. So what does everybody do? How do they play a role in terms of the audit? Want to help explain that and kind of clear the picture there. So we have your financial advisor, the TPA, the record keeper, you, the plan sponsor, us as auditors. There's a lot of people at play here, right? So the financial advisor, not only are they there to help support your employees through education, and they're in there helping support the investment committee going through review of investments, but whether they're meeting with you on an annual basis, semi-annual, quarterly, they're doing those things. They're also keeping track and putting together meeting minutes for you, recapping the decision making, what was talked about. They may maintain a fiduciary folder containing other plan documents as well. So that's typically what they do as far as supporting the audit. The TPA will have copies of plan documents, may have loan reports, prepare the Form 5500, the non-discrimination testing, and have copies of participant forms. So it just depends on the service contract that you have with them. What type of setup do you have? Is it a bundled plan? If it's a bundled plan, then the TPA and the record keeper are one and the same. But if you have an unbundled plan, the TPA is an independent party outside of your record keeper. So that's why we itemize those here. Record keeper, custodian are your Principal, Fidelity, and Powers of the world. They're the ones who hold the assets of the plan. They maintain participant and plan level reporting, should provide auditor access. That's one of the things we ask for right out of the gate, is auditor access to make the process smoother. And that provides, they also provide copies of online participant transaction records. So, and then you, the plan sponsor, for those plan sponsors on the line, you're more charged with really providing payroll information that, the service providers don't have access to. We'll talk about the deposit schedule and how that works. And then the copy of the fidelity bond, for instance, those are things that we'll ask of you for. And then any hard copy documents that might be pulled from personnel files, HRIS screenshots, copies of I-9s, things like that, is what we would ask of the plan sponsor. So required documents. Before we dive into these, I want to premise these next 4 or 5 slides just by saying that, I'd say probably about 75–80% of the information that we obtain is going to come through the service provider. So don't be alarmed by this long list. It's not too daunting. But we'll go through it. And if you have questions, feel free to ask. For a first year engagement, we ask for prior year information because we want to get comfortable with the opening balances. Jason will dive into that in this next stretch here, but that's why you see for this particular list is for a 12/31/24 audit, but you will notice some 2023 dates in here, and that's because we do have to get comfortable with the opening balances. So we'll ask for some payroll records for the prior year Form 5500, which we can pull directly from the DOL website ourselves with just the plan name. Auditor access to the record keeper's website, which I mentioned. This will allow us to be able to pull all the trust reporting package information, ad hoc reports, things like that, participant statements, just to make the process smoother. There's really no need to have the auditor flow those requests through you if we can get limited auditor access and pull that information ourselves to make things run smoother and more efficient. Besides the payroll reports, other things that we'll ask for is non-discrimination, item number 6, non-discrimination test results. If there's any liabilities or any accruals that we need to book for the 2023 plan year, the financial statements really require comparative statements, a comparative balance sheet. So anything that needs to be accrued for in 2023, for a first-time audit needs to be reflected on the financial statements. So that's why we ask for some of these 2023 reports to make sure that things are properly accrued for. If going above that, item number 5, I know I'm bouncing around, but just want to continue the flow here. If it's a prior year audited plan, so if it's a takeover plan by us or for any other auditor, if there's a change, they are required to talk to the predecessor auditor and inquire of things that might have happened in the prior year. Are there any outstanding things that are out there? There's about 4 or 5 basic questions that are standard process. So just know that an introduction to the predecessor auditor is another item that the auditor would request on a takeover plan. And if the prior year was not audited, then we would have to do additional opening balance procedures on our end in order to get comfortable with those opening balances. Copy of fidelity bonds. So we just want to make sure that the assets are covered for any crime, fraud, theft for the planned year that's being audited. So a copy of that declaration page or proof of insurance is basically what we ask for there. The plan documents, which are made up of your adoption agreement, your basic plan document, item number 8, your IRS opinion determination letter, which is basically the IRS's blessing that the plan document it qualifies to make the plan a qualified plan. Item 10, plan amendments associated to the plan. So you have your plan adoption agreement, which has all your provisions in there, what you've marked off for your plan. Any amendments to that adoption agreement we would want as well for our file. And then the summary plan description, item 11, is going to be what you send to your employees that puts all those provisions in layman's terms for them. And it's a much more summarized document so that the employees know exactly how the plan is functioning and what those provisions are all about. Meeting minutes, I alluded to those when I talked about the advisor and what they can provide. So we put party responsible here on the right, knowing that, yes, the plan sponsor should have these items on file, but we know exactly where to chase those things down if you happen not to have a fiduciary folder with all these things in there. But it's just best practice to maintain those internally. And at the end of the day, the plan sponsor is responsible for maintaining those minutes. But oftentimes, the advisor, they're the ones who draft them and keep them as well. Service agreements. So, for any contracts you have for any expenses that are paid out of the plan, you should have a service agreement tied to that. So if it's your trust agreement with your custodian record keeper, we'll ask for that. The TPA, if you have a service contract with them, we would request a copy of that for our file as well. And we use it basically to make sure there is one in place and that the fees are reasonable. That's part of what we do as far as our testing. And then that it matches what the 5500 is reporting as well. So all those things are looked at when we're looking at those service agreements. Auditor's package, you'll notice a lot of this comes from the record keeper on the far right for party responsible. When we say audit package, we're talking about everything that comes from the record keeper. So the complete and accurate certification, the plan statements, participant detail, loan reports, detail of distributions, so the different schedules, detail of fees, the SSAE 18 report or SOC 1 type 2 report is the internal control testing and work that was done at the record keeper level. So we'll cruise through those and make sure and document that there's nothing that we need to update our risk assessment for and test maybe more if there are exceptions to some of the testing that was done at the record keeper level. So that's a report that comes out annually. Subsequent plan year statements. Why are we looking at subsequent year information when we're auditing 2024? The reason why we do that is because if there's anything major that happens after the audit report date, but before we actually issue the audit opinion, say in the summer of 2025, we have to report that, if it's material in nature. Let's say you have a planned merger in an acquisition, or let's say you're terminating the plan and the plan terminates during that period between the audit opinion, the audit report date of 2024 and the date that we issue the financial statements, then the public should be aware of that happening, right? If there's major plan amendments, provision changes, things like that, then we'll report it as a footnote and additional disclosure in the financial statement. So sometimes the subsequent statements that we pull from the record keeper will draw some of that information out, and that's why we ask for that. 2024 non-discrimination test results. We'll ask for that. Copy of the 5500 draft. And then these might be applicable, might not be, but if you have a non-elected profit sharing calculation, we'll want a detailed statement by employee showing the allocation so we can test that, along with the company discretionary matching formula that you use to make sure we recalc that and it works out. when we recalculate for testing purposes. And then the company contribution true up. If there's a true up at the end of the year, similarly to the non-elective calculation, we'll want a copy of that schedule to be able to tie out the annual activity for at the participant level. Copy of the payroll register. So these are the same as the 2023 for a first-time audit that we asked for, and it's just a couple reports mainly, and with it we can do a lot of testing behind the scenes. So it's typically the last payroll register of the year along with your year-to-date payroll report. Oftentimes that year-to-date payroll report will have what we asked for in item 30 beneath it, so pay code legends. If let's say you're with ADP, for instance, the master control report should have both the year-to-date information along with the legend that shows all the pay codes. And the reason why we ask for that is because we want to test your definition of compensation for the plan. So every plan has its definition of compensation. Let's say for you, it's all W-2 earnings with no exceptions, for instance. We want to make sure that all your earnings, all your pay codes that feed into the W-2 as gross wages are being used to calculate your deferral percentage for the 401k. And same thing with the match contribution, right? So there's a definition of compensation for the plan, and we just want to make sure that the pay codes that are feeding into it, that you're not, falsely including or falsely excluding any pay codes based on that plan document and the way it reads. Copy of the census file. So the reason why we ask for the census is because the census that you submit at the end of the year to your TPA, at the end of the day, is what feeds into your non-discrimination testing, right? So is that complete and accurate? And the way we look at that, the way we test it is by comparing that census data to your year-to-date payroll to make sure that all that information reasonably agrees, right? So that census data should have the date of birth, individual's date of hire, date of termination, gross wages, employee contributions, and employer contributions, so that it's we can test it in different ways. We can look at total employee contributions, trace that to the record keeper information. Same thing with the employer contributions. And we just want to make sure nobody's excluded from that census data. Sometimes we catch that maybe terminated participants during the year are excluded. And so at that point, it could affect your non-discrimination test results. So we'll recommend rerunning the test with accurate data to make sure that, you're truly compliant at the end of the day when it comes to the non-discrim testing. Copy of the record keeper access report. So number 32, this is more of an internal control procedure that we do to make sure that let's say you have terminated employees that had access to the record keeper website. We just want to make sure that, those people are eliminated from having record keeper access. So it's just part of the process. And, if you do happen to have people that should not have access, then we'll give a best practice recommendation to remove those and to have a process in place on a go forward basis to have a checklist, right? And I assume that there's checklists whenever there's a terminated employee to just add that wrinkle into it. Do they have access to the record keeper website? And if so, let's make sure that they're removed as well from that angle. Completion of an attached internal control questionnaire. So this basically is more for efficiency purposes. We'll send out an internal control questionnaire that goes through maybe 10, 15 questions. And what it does, it affords us to streamline the process so that our internal control documentation phone call that we have, which is about 30 to 45 minutes long, doesn't turn into an hour 15, because they're more like questions that require maybe putting individual names in of who's part of the committee, the investment committee, spelling out, names, titles, those sorts of things that can be easily filled out through a questionnaire rather than spending time doing that over the phone. So we just try and streamline that process, and it's not going to be a daunting, huge checklist. I've seen, some crazy checklists that have been issued by auditors over the years that are 10, 15, 20 pages long. And we just try and streamline and have a conversation about the internal controls. So setting up a 30-minute phone call to talk about how you process payroll, how you process contributions. It's an easy thing to do over the phone and document, and then we just update it continually year after year as things change, as personnel changes and things like that. So, and then the last one here, 10383C acceptance letter is you acknowledging that we are performing a limited scope audit. And so we just ask that you print and print that on company letterhead, sign and return that to us so that we can stick that in the file, and we'll provide a template for it. The deposit schedule. So this is what I mentioned should be maintained at the plan sponsor level, but we can also produce this typically from the record keeper's website just by populating the data points. And sometimes, well, oftentimes we'll actually put this together and just have you confirm the paycheck dates just to make sure that those dates on the first column are accurate, because we use this to test timeliness of contributions, right? So this is an important part. You know, DOL harps on this every year. Timeliness of contributions is typically one of the top errors that happen during the year. Things fall through the cracks. Maybe people go on vacation. Maybe you've got a major project. Maybe you have a payroll provider change. And so you might have one or two late remittances during the year. Don't be alarmed. It's normal. Things happen. There's a way to fix it. It is an administrative burden to do it, so you do want to stay on top of it. But if you do have you know, that issue, we'll help you, you know, figure out how to correct that situation. It does have to be disclosed in the financial statements and the Form 5500. So you definitely don't want to get accustomed to having late contributions. But again, don't be alarmed if you have a year where it does happen. The schedule should be comprehensive in that you want to break out your deferrals. So, you know, if you have the Roth feature, you want to break out the Roth deferrals. If you have different forms of employer contributions flowing in, if you have safe harbor, non-discretionary, you want to carve those out as well. Loan repayments, that total should match what the bank statement or record keeper is showing. So that's what we're showing on the far right with the reconciliation. If it's off, if you do have a variance, it's probably because you used some forfeitures and applied some forfeitures against your match contributions, which can be done as part of the plan. So don't, you know, that's part of the reconciliation process. So for instance, on this 1/31/2024 payroll that we recapped here, there was contributions that went into the plan of $1,600. But if I were to look at your bank statement, you might show $1,100, and that's only because there was $500 in plan forfeitures already in the plan that got allocated towards the match contribution, the $500 that's showing in under the employer match column. So that's how we reconcile the activity as far as the deposits are concerned.
Thank you, Alex. So as Alex already alluded to, is running through the example PVC listing. And again, that listing is more specific to us, but we would expect there to be a lot of common data points with any auditor that you work with. So if you're like, they're not asking for this, or asking for that, doesn't mean that they're bad, but maybe it should maybe prompt you to ask some questions, just to make sure that they're doing what they should be doing. And as Alex had mentioned, we do have to do some testing regarding beginning balance test work, either in an instance where a plan has never been audited before, or in the instance where it was audited before, but for whatever reason, we can't review the work papers of the auditor who worked on it previously. Or sometimes we can make the conscious decision to say it's just going to be faster and easier if we just test the stuff directly versus looking at their work papers. Generally speaking, for our approach when we look backwards at opening balances, I think the key thing to remember there is that we try to look in pretty deep detail up to 2 years back, with the greater emphasis on the most recent immediate year. So for example, minus year one, I'll just say, so the first year prior, we would be looking at both, if we could, the trust reports and the payroll records, at least at the very end of that period, to make sure that our beginning point for the audit makes sense and everything's synced up there. Year minus two, we would primarily only be looking at the trust statements. We would only ever get into payroll if there was something that was really sending off alarm bells, but that's a very rare thing. I haven't done it while I've been here, or maybe if I have once, it's an uncommon occurrence. Beyond that, we're just going to be gathering information from the Form 5500. auditors have different approaches when it comes to testing opening balances. So again, if you have a plan where it's going to be audited and it hasn't been audited previously, that is another valuable question to ask or consider when you're going through the evaluation process. Not just, is there a cost associated with it, but two, is the auditor willing to give you some sort of framework or general idea of what they're going to be looking at? So just something else to consider in that nexus. Next slide, please, Alex. All right, so this is a presentation where Alex and I have done an entire 1 hour presentation just on common audit findings. We are not going to spend that time on this here, so please don't have a heart attack. But I think there are some very valuable data points that should be conveyed when looking at these points here. So the first, and I think one of the most important things to remember, is that when you go from being a plan that is subject to the small, your small plan exemption, meaning you're not subject to audit. When you're at that standpoint, you can, as long as contributions are made to the plan within a 7 business day safe harbor, they are not delinquent. Once you are a plan subject to audit, it opens up completely. And the best way to describe it is you need to get the deposits into the plan as soon as possible. There is a demarcation the DOL provides where, from a statutory standpoint, deposits are always late. And this is, again, participant contributions. So it's payroll contributions and loan repayments. That demarcation line is the 15th business day of the month following when the contributions are withheld from participants. It's a mouthful. Just know that it's out there. But any point between there and effectively day zero, after payroll is actually paid to participants or to employees, is potentially delinquent. And where you draw that line in there is going to be based upon your risk tolerance and how frequently you can deposit monies into the plan. So if you're frequently able to deposit monies into the plan after 3 business days, and you have one that's at 5 or 6 days or more, maybe 6 or 7, that might be a delinquent contribution. That is up to you as the plan sponsor to decide. Your auditor should not be making that determination for you, regardless of who your auditor is, because that is not our job. That is a management responsibility. But I harp on the delinquent contributions because we run into it the most frequently. It's 7 business days. Stephanie, I saw you had to ask the question. It's 7 business days, is my understanding. But again, that's only applicable if you're a non-audited plan. Once you're an audited plan, it's really wide open field. With regard to the definition of compensation, the plan document, not following the plan document, I think the most critical element in these data points here is really definition of compensation. That is by far and away the issue that, when we run into it, is the most problematic. As Alex was referring to previously, with the W-2 compensation, don't assume because your plan just says W-2, no exceptions, that it's easier to operate. It actually might be prudent for you to possibly pair off some of the compensation codes so they are not eligible for deferral, because it ends up causing unexpected headaches for your payroll team to be able, or the payroll team of the plan sponsor to be able to handle them. Again, this is something where we cannot make the determination, nor should any auditor ever make the determination in terms of interpreting for the plan sponsor what the definition of compensation is. But auditors should be asking the question, okay, so we see this compensation code. It appears to be eligible based upon your definition of compensation, but we don't see deferrals happening on it. Does management have a reason for not doing so? The answer is no. Or management looks at it and says, shoot, we don't really have any justification for our position. That's a finding. And depending on the magnitude or potential magnitude of that finding, it could hang up the audit, but that's going to be an audit by audit and auditor by auditor question. But just know the definition of compensation is, in my mind, the most problematic of all the ones on here, because it seems the most pernicious and one that we run into very frequently. I would say if you've changed your service providers within the last year, if you changed your payroll providers within the last year, or you've been at the same service provider, but you've had a restated adoption agreement and or plan document, you should make it a point to do a detailed examination of your payroll system to help ensure that the payroll codes that are within that system do correlate with the plan's definition of compensation. And it is not uncommon for management to have to make a call one way or another about the position they're going to take on a particular compensation type. Unfortunately, from the DOL's perspective, there's not really a materiality here. So you should, if you have even a very small error, it's going to get flagged, or it should be flagged by the auditor. It doesn't mean it's going to hold up your audit if it's truly an immaterial compensation code, but it is something you're going to have to make a determination of, are you going to fix it? Or is management going to decide to just roll with it and just take the risk that if they ever caught with it, it's going to be a more painful correction? That is something we cannot determine. No auditor should be determining that, but it's something you as a plan sponsor just absolutely need to be aware of. These last points, I think you could probably surmise almost all those by saying you want to make sure you're looking at your controls to help ensure that data, participant data especially, is being communicated completely and accurately to your service provider, because that's what's going to be driving your auto enrollment. On the flip side, you also want to make sure, if especially your deferral rates by participants and their deferral types are being elected on a website and then being communicated back to the plan sponsor, do you understand the controls that are in place there? If they're automatically connected and talking to each other, cool. You might want to consider just spot checking it once or twice a year to make sure there's no problems there. If it's a manual process, then you absolutely want to be looking at and thinking about the controls over helping to ensure that the deferral rates and deferral types that are elected by participants are actually being toggled and engaged within the payroll system. Those types of corrections can be very problematic and annoying to address as well. But I think those would be the two controls that we would say are probably the most important to helping ensure that everything is operating with integrity. Again, that's ensuring that what are you doing to ensure that participant data is communicated completely and accurately. And on the reverse side of that, deferral rates, if they're coming from a third party back into your system, what do you, if it's an automatic feed, are you at least spot checking it periodically? Against once or twice a year is probably sufficient, but that's up to you to decide. But if there's a manual component, whether it's coming from a third party website or using good old forms internally there at the plan sponsor, what are your controls to help ensure that things are being entered correctly physically into your system? So with that, I'm going to turn it back over to Alex to bring us home and discuss the timeline, at least that we use for audits, but what you should be generally expecting in terms of the milestones, regardless of their cadence for your auditors.
Thanks, Jason. Great tips, great hacks there that you shared as well. So, as far as the timeline, we typically say 6 to 8 weeks is generally what we want to achieve, and that's from the time we get a complete um, audit package from the record keeper. So once we get that information, then the clock starts ticking, and really it's up to both sides of the equation. Is everybody responsive as we put out requests? Are you timely responding to the auditors and sending and uploading information requested within timely fashion? If so, then this 6 to 8 week timeline should function and work smoothly. But week 1, we're obtaining and reviewing the audit package, sending out selections at the participant level, and scheduling a date for remote field work. That's typically what happens week 1. If there's, let's say, a first-time audit where we have to get introduced to the predecessor auditor, that week 1 is when that gets done, along with gaining the access to the record keeper website. All those things are typically happening in week 1. Week 2, behind the scenes, a lot of this stuff happens. We'll go through analytical procedures on our end. We'll build out the work papers, document internal controls. So we'll set up that 30, 45-minute phone call to talk about that and get that out of the way. And then we're already drafting financial statements in week 2 as well. So all that happens then. And again, most of it happens behind the scenes. So there's very little, work involved at this plan sponsor level at this point. Addressing any questions week 3, if there's any issues with the audit selections that we sent out, any questions related to those requests, we can hash those out mid-audit, set up a phone call if we need to, or go through it via email. And then week 4, preparing for field work. So assuming that the information has been received by us through the portal, as far as the support for testing. We'll take care of the field work, and it's done virtually and remote basically. So all these audits are done remote. We do have people that are all over the map. So if you do have more antiquated forms, processes where you feel like it'd be smoother to get it done on site, we can manage to get that done as well. But yeah, so we'll prepare for field work and perform first review of the work papers. That's done internally as well at the manager level. And then weeks 5 and 6, we'll wrap up work papers, perform the actual testing, close out follow-ups, any loose ends that are out there, perform a second review. That's done by a higher level, doing a quality control review of the financial statements, and then a partner will do a second read, what we call a second read on the financial statements before they get drafted out to you. So by the time you're getting a draft of the financial statements, you're getting a very clean report. How do we stack up at the end? And we'll go through this just for the sake of time. But again, going through what the DOL, basically the DOL considers significant factors that correlate to audit quality. These are them, the number of audits performed, the firm's revenue from planned audits, what percentage of the firm's revenue is that? Typically 10% is a good barometer as they put it out there. We're at 100%. Continuing professional education, typically engagement partners, for them to be focused in this arena, the DOL, will say, as long as they have about 24 hours annually in employee benefit plans, that's a pretty good barometer. We require from our professionals to complete 40 to 60 hours annually focusing on this, because this is all we do. It's 100% of our revenue. So why would we spend time educating ourselves on other revenue sources that we're not really involved with, right? So I'd say we're leading the pack when it comes to this space. We're 100% specialized. We have industry competitive fees. So when you tie that with the time savings and efficiencies involved in what we do and how we do it, I think it's kind of a no-brainer. But I know there's a lot of great firms out there that you can definitely look at and consider for your plan audit. But these are all just resources to kind of help you make that right decision for you. But we strive for pain-free audits. So clients love our efficiency, streamlined audit approach. I actually reached out to a handful of my own clients over the past few weeks just to find out, how many hours are you using to support the auditors in getting the audit completed. I just did this, because I was curious, because we kind of have an idea of the hours, but we're not 100% sure because it's not part of like our client feedback survey that we put out every year. So I was actually alarmed by the response, because I thought it was more like 8 to 10 hours, but it ended up being closer to 4 to 6 hours is what I gathered from just talking to my own client base. And so, I think that's definitely something, a piece that should be shared, because if you're focused and you're working on these audits and spending 20, 30, 40 hours supporting your auditors to get this thing done, it doesn't make sense. You should consider not only the fees, but also the time spent by your team, your HR folks, your payroll folks, in supporting the auditors to get this thing completed, right? And then single EVP focus. Our entire firm is dedicated solely to this. So no matter who is assigned to your engagement, you're going to get a quality auditor auditing your plan. Thank you so much. I know we went a little over. Open to questions. Happy to address anything that's on your mind here. You've got our contact information. You've got our LinkedIn QR codes. So definitely feel free to connect and ask away if there's anything that comes up beyond today that you want to ask about, or if you want us to look at your plan, we're happy to do so anytime. Jason, anything you want to add?
No, this is, again, we do this each year, and we feel like there's just a lot of good information here to put out into the universe. So if this is your first time attending, thank you. Hopefully you found something useful here. You're a repeat attendee. We don't have any awards to give you. Maybe we should give out gold stars or something in the future, but regardless, thank you everyone for joining us. And yeah, if you have any questions on these or just need to bounce an idea off an auditor, feel free to reach out. We love fielding those sorts of questions.
Good stuff. Thank you for your time. Enjoy the spring day. I know it's opening day of baseball. We've got March Madness resuming with the Sweet 16 today. So that's cool. A lot of fun stuff happening. Enjoy the day. Thank you for spending these 45 minutes with us.